Okay, here we're going to be looking at a consolidation where we have a reverse acquisition. So what do we mean by a reverse acquisition? A reverse acquisition occurs when a publicly traded corporation issues its shares to acquire the interest in a larger privately owned corporation. Essentially, the private corporation is going to go public. So looking up at our example here, this private corporation is going to get 30,000 shares of the public corporation stock here, and the private corporation is going to give the public corporation their total number of shares that they have here of 10,000 shares. And the fair value of the share here for the public corporation at this time would be $25 per share. So looking at our balance sheet here for the public corporation, what we have is a book value here, but we have to determine its fair value here for the assets and liabilities. So doing that, the total assets fair value here is $400,000 less the fair value of the net total liabilities here of $100,000. So the fair value of our net assets for this example here would be $300,000. The difference between the total assets at their fair value and the total liabilities here at their fair value. So going down to determine the goodwill here. First we have to determine the implied price here in this acquisition. So prior to the acquisition here, the public corporation had 20,000 shares here on their books, and at the market price here of $25,000 per share, the value here would be $500,000. So the implied price here of $500,000 less the fair value of the net assets of $300,000 gives us goodwill here of $200,000. Okay, to make a point before we move on here, the public corporation will issue 30,000 additional shares here to the private corporation. So the total number of shares that are going to be outstanding for the public corporation is going to be the 20,000 shares that it currently has on its books here that are issued, plus the 30,000 additional shares that it's going to issue here to the private corporation. So the total number of shares issued by the public corporation is going to be 50,000 shares. And then to make a note here for the looking at the balance sheet here for the private corporation, we have just the book values shown here for the assets and liabilities, and the fair values, well, they can't be reassessed up to their fair value because the shareholders of the private corporation are going to be the controlling interest after this acquisition, and the private corporation cannot revalue its assets to its fair value since they will be the controlling interest. So what has to happen here, the public corporation is going to be the corporation that must have its net assets adjusted up to its fair value, and we looked at that earlier up here for the public corporation. Okay, looking at our distribution schedule. First, to determine the fair value here of the public corporation. Now, the public corporation is going to be the legal parent, but the shareholders of the private corporation are going to be the controlling interest here in the public corporation after this acquisition here. So prior to the acquisition here, the public corporation had 20,000 shares outstanding times a market price here of $25 per share, and that would equal $500,000 here. So the value here of the public corporation here was $500,000. And now looking at the private corporation, their ownership percentage, they received 30,000 shares here from the public corporation, and then there was a total of 50,000 shares outstanding here, the 20,000 that they originally had on their books plus the 30,000 shares that they issued here to the private corporation. So based on that percentage, we come up with a percentage here of 60% ownership of the private corporation owning the public corporation. So they become the so after this acquisition here, the private corporation is going to be the parent for the controlling interest here of 60%, but they're not going to be the legal parent. The public corporation is going to remain the legal parent in this case. So looking at our non-controlling interest here. Now after this acquisition, the holders here of the 10,000 shares of the private corporation become the non-controlling interest here in this acquisition. Okay, now going through our distribution schedule. Well, our fair value here for the public corporation, we determine that to be $500,000, and then it will be proportioned out here, 60% to the private corporation for $300,000, and then the non-controlling interest would get $200,000. So now we have to subtract out the book value here for the equity being carried here by the public corporation. So we've got the list of the stocks, the additional paid-in capital, and the retained earnings here, and that total $200,000. So the private corporation is going to get 60% of that portion, and the book value in that case is going to be $120,000. And then for the non-controlling interest, they're going to get the 40% proportion here, and their book value in that book value is going to be $80,000. So we have to determine the excess of the fair value over the book value. So the total amount here for the public corporation, that would be a total equity of $200,000 less the fair value of the public corporation of $500,000. That gives us an excess here of $300,000. So that would be the excess of the fair value over its book value here of the equity. Now the private corporation, that would be the $300,000 here less 120, so we'd have $180,000 for its excess here, and then a non-controlling interest would get the remaining 40% here, or 200 minus 80,000 here, and that would be 120,000. Okay, looking at our value analysis, we already determined what the goodwill would be here, and that was $200,000. Now looking at the proportions here, the subsidiary's fair value is $500,000, and then proportion that out here, 60% to the private, 40% to the non-controlling interest, and then the fair value of the net assets, we had a total amount here of $300,000. So we proportion those out here between the private and the non-controlling interest. So the goodwill here of $200,000 is divided up here, 60% to the private for $120,000, and then the non-controlling interest would get $80,000. All right, looking at the journal entries here that would have to be made in this consolidation. First, looking at our adjustment to our accounts here, the public corporation would have to have its accounts here adjusted up to its fair value, and the only changes here were the fixed assets would have to be increased here by $100,000, and then we'd also have to include the goodwill here of $200,000. So our total adjustments would have to be $300,000 in this case, and that matches as our distribution schedule here for the excess of the fair value over the book value here for $300,000. Now looking at our other adjustments that we'd have to make here, our investment here in the private corporation of $300,000 would have to be eliminated here. First, the excess of the fair value over the book value here of $180,000 would have to be eliminated, and then the 20% or 60% interest here in the equity here of $120,000. That would also have to be eliminated. So our investment here in the private corporation would be zeroed out here. And then the public corporation's equity here, that 60% up here would have to be eliminated. We started out with here $120,000 here, and then it would be reduced here by the common stock here, additional paid-in capital, and the retained earnings. So that would also be zeroed out here. And then the remaining amount here for the non-controlling interest, that would be going in here to the retained earnings here for $120,000.